In this week's update, US data puts the skids under the markets, but rotation shows that all is well. Gold, well, that didn't last too long. And copper, what does the sudden sentiment shift mean? My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. All right, let's kick off with some perspective. If you just follow the main indices, as I know a lot of people do, because most of the mainstream commentary is around just the main indices. So it's obviously catering to demand. If you do that, you're just not going to get the right information. That's why every single week in the service, I show you the sector money flows in America and in Australia, because it's the overall sector flows and where they're going, because they're always in a degree of long-term rotation. So that's the far more important information. And we'll, of course, look at that again today. Now, semiconductors, I guess, have been the story for the last 8 trading sessions. They took a huge whack the Friday before last, which scared the pants off a few people. But as I said, let's keep our head cool and see what the follow-through was. And it was pretty mild, to be honest. So any sector that has run the way that semiconductors was going has to take a break. They have to have a pause. It's unsustainable. So you'd almost have to say that what happened in semiconductors is, of course, that was expected. And so far, the follow-through selling has been very mild. And given how emphatic the prior Friday was, it would be normal that follow-through selling was almost instantaneous if it was going to be a change. And so therefore, I can only conclude that it's just a pause and nothing much more than a pause that won't last terribly long. But more importantly is that the money has not left the market. The rotation into other areas has been quite emphatic, as we'll see when we look at those sector money flows. So that's the important thing. That's the good news message. So where should your money go? Well, what I've been focusing on now for a number of years is not necessarily just growth stocks, not necessarily just value stocks, but stocks which offer growth at a reasonable price, which is a term that you may have seen. And what does that mean? It means that the growth is truly strong and sustainable. It's also highly probable, because, you can always, lots of companies have huge growth potential, but they never realize it. So you've got to have both strong growth and highly probable long-term growth. And they're the stocks that you can really build wealth creation around. Now, as a very simple indicator, if you want to chase some of these things down yourself, use the PEG ratio, which is the PE ratio divided into the growth. And if the PEG ratio of a stock that you're looking at is significantly less than the rest of the sector average. Now, different sectors operate with different ratios, the same as different sectors operating in defined PE bands long term. So if you've got a stock where the PEG ratio is significantly less than its peers, then that's one tick. It's not the whole story, but it's one tick. And ideally, if the PEG ratio is less than 1, but I'm not shy about paying up to 1.5 if all the other boxes get ticked as well. So there's just a simple place to start. There's no point in buying a stock that is hugely expensive, even though it may have the growth, because that future growth has already been priced in. So some of the best places to look, founder-led businesses are just a great source of terrific long-term wealth creation. And there are a number of them in Australia at the moment, and we've got a number of them in the Insiders Club portfolio. And they've been amazing long-term wealth creators and will almost certainly continue to be in the future. So there's a great place to go and look. Stocks that have got pricing power. It's just so important in these days of rapidly rising costs and a very uncertain economic and geopolitical outlook as well. Next, sectors or stocks that dominate their sector, that have an almost unassailable lead from the competition, high barriers to entry, or to put it another way, large economic moats that make it difficult for the competition to encroach on their cabbage patch. So they're the places that you should look. Now, occasionally I get a question from outside the membership about, some tips. What about some tips from someone who perhaps knows more about the market than most? The only thing I would say about that is seeking tips is just a crazy approach. It's really not smart at all because you've got no context. You don't know whether that recommendation is remotely suitable for what you're trying to achieve. There's no risk management associated with it. There's no entry and exit and profit taking information associated with it. And there's no hope of consistency. So if you're relatively new to the market and you're surfing the net and you're looking for information and you think that some tips from knowledgeable people is the way to go, then please abandon that approach. And I'll come back to that point later on in the presentation. American stocks, the S&P was down slightly across the week. Semiconductors, they were down 3.1% for the week. And as we'll see, the follow-through was pretty mild, really. But if you include the prior Friday, then it's down 9.2% from the peak. So, that's significant. But when you look at the chart and put it in context, it was a big one-day move. Nasty looking candle, as I talked about last Sunday, but really the follow-through was lacking. And elsewhere continues to look extremely robust, as we'll see. The US dollar index nudged a little bit higher on CPI and PPI data. The 10-year yield spiked to 4.32, so that certainly didn't help technology stocks. And the VIX, however, slipped down to 14.4. So the general market wasn't terribly concerned about what had happened in semiconductors. So let's jump in and look at some charts. There's the S&P on a weekly chart. So you can see the last 2 weeks have really just gone sideways. But they haven't pulled back. And this has been such an amazing run since the lows of October 2023 that you would have expected something a little bit more than this. Look, and it still may come because we've had such an amazing run, and February and March are often weaker. February definitely wasn't. March hasn't been so far. It's been more of a pause than any sort of retracement. But at this point in time, that's what the indices are doing. But as I said at the start, if you just follow the indices, it's just such a misleading indicator or way of looking at it. This is how you want to look at it. Before we go there, let's just look at semiconductors. So there was the Friday before last, a huge reversal candle, but follow through is important. And this was mild. Look at the candles, the range of the candles. They're all fairly modest. You've got lots of wicks on the bottom, which is indicating, that's a bit of a bullish sign. The fact that there are buyers stepping in. So extended wicks here and here virtually every single day. And all that's happened is that the semiconductor index has come back to the 20-day moving average. I mean, so what? That's an indication of a strong trend. And the volumes, they weren't sustained at the high levels that we saw the Friday before. So this is all a pretty mild reaction to me. This is the NASDAQ versus the S&P. It's, of course, it's rolled over, but it's what's happening within the S&P that's important. So, let's not overweight this one too much. This is semiconductors versus the S&P as well. Certainly some shift there, but not quite as dramatic as I expected to see. But let's get into the weeds and have a look at what has happened on a sector basis. So over the last quarter, communication services has been the very strong leader. Banks have done incredibly well. Energy was lagging the pack at the start of the quarter, but has made a roaring comeback, as we'll see over the last couple of weeks as the crude oil price has gone up. Healthcare has been pretty consistent. Now, XLK was also doing well. It was right up there in second or third place for much of the quarter, but it has slipped definitely in the last week. And then materials, consumer staples, if this truly was a market top, then consumer staples would be performing far, far better. And consumer discretionary has now sort of dropped to the bottom. Let's zero in there and look at the last fortnight to get a bit more colour on what's actually happening right now. And you can see energy has just roared back into prominence as it was a year or so ago as the oil price has gone up. Materials have also bounced. That's helped a bit by gold, but also by other parts of the US materials market that don't get reflected here in our market. So the materials index in America, you really can't draw any conclusions for the materials index in Australia, which is, so heavily influenced by the iron ore price, as we'll see. So that's been the last couple of weeks, and certainly technology is taking a breather. But many parts of small caps, if you look at, there's 220 odd industry groups within America, so you couldn't put up a chart, it'd be way too busy, but there are just numerous industry groups in America that are tracking along very, very well, and particularly the small and mid caps. Let's look at Australia. This is over the last quarter. Information technology has been the unquestioned leader. I spoke about that last week, particularly with WasTech Global and Xero. Finance has done well over the last quarter, and particularly of late, small caps have made a resurgence. So that's very positive, and they've held up extremely well. The materials are sort of dragging the chain at the end. Let's zero in on the last couple of weeks, though. Small caps just got their nose in front, which tells you something about what's happening in the Australian market and where you should be looking. So that comes back to the founder-led theme that I spoke of earlier. Healthcare is up there, and just taking a little bit of a breather of late is the information technology. Now, as opposed to America, the energy sector in Australia has been downright disappointing, and it was really only the turn up on Friday in the energy index in Australia that really saved them at all. Otherwise, the energy sector would be right back down the bottom. So again, what's happening in energy in America is not a direct translation to what should be happening in Australia, because there is significant difference. And I think a lot of the woes of the energy sector in Australia are due to, political and economic policy around energy, which is really a complete dog's breakfast. No one knows where they are, and so therefore investors aren't proceeding with any sort of confidence. So that's the American market. We'll just have a quick look at the currencies. So we had a little bit of a blip in the US dollar. We're still within an overall big sideways consolidation, and that, of course, just kicked the Australian dollar down a little bit. So turning now to Australia, 64.98 is where our dollar finished. Our index lost 2.3% across the week, and we may see a little bit more selling on Monday. It was the largest weekly fall since September of last year, so it was significant. But certainly the overseas lead from America shouldn't create any issues. The US data was part of it. The hotter than expected CPI and PPI numbers, so that did play into it a bit. But look, iron ore was down 20%, down to 105.50. So that did the damage for the materials sector, and materials still has a reasonably significant impact on our overall index. And lithium futures also, which had been running up, got smashed by about 7% on Thursday night. So that certainly didn't help matters either. But it's the XSO and XIJ that remain in the best shape within the Australian market. So let's go and have a quick look at that. So the ASX 200 on a weekly chart, we'd broken out, and then we've immediately turned around and retested that breakout zone at the index level. This is emerging companies index. You can see just how strong it was, and despite the selling on Friday, it managed to recover quite well, and that's trending very, very strongly. That was energy daily chart, so take out Friday, and it was a very, very disappointing week considering the way that the oil price has gone up, as we'll see. Banks did really well, but they were the opposite, and they had a big down day on Friday. Healthcare, not much going on there. Information technology certainly doing pretty well, but this was one of the big drags on the index, the materials sector, which was down quite significantly. Let's have a look at the iron ore price. So the iron ore price had peaked out at around 145-ish, and you can see just how much we've come off. So that was January 2nd. So this year it's been all downhill, and significantly so. But look, up here was given what's happening in the Chinese property sector, what's happening in the Chinese economy, the fact that the character of Chinese growth is changing. I was never comfortable with the iron ore price up here. All right, turning now to gold, precious metals. Gold lost $23 to $21.56. So, that was in good part because of the hotter inflation numbers that really cooled the enthusiasm for gold. In Australian dollar terms, though, we're still pretty close to 3,300, which is just as well because so many Australian gold miners now, they're all in sustaining costs, are up in the sort of $1,800 to $2,100 an ounce category. So it's just as well that the Australian dollar gold price has kicked on as well as it has. Overseas, the major miners, they're still not moving very convincingly. There's a couple of local performers that are doing very well, that are trending strongly. We looked at that last week in Portfolio Analyst. If you haven't had a look at Portfolio Analyst, then there's a 2-week $1 trial available there. So you can get my thoughts on the gold sector in Australia. So that's what's happened in gold. Let's put that on the chart. There's the Aussie dollar gold price on a weekly chart. So we pretty much marked time, but this is looking very, very strong. The daily chart in US dollars and the weekly. It's still broken out, but there was, it was a week of pullback for the gold price. And when you look at silver's starting to respond a little bit, but the silver market in Australia is difficult to find stocks, to be honest, that you could invest in reliably. Other commodities, copper was probably one of the big stories of the week, up to $4.11. Nickel edged up fractionally, but is still pretty somber. What's been driving or keeping the copper price down has been the concern about global economic growth and therefore demand, and supply side issues with mine closures and mine disruptions has been largely ignored. Well, finally, a couple of things happened that meant that the copper supply side has now become the price driver. So that's what the market has now suddenly shifted their focus to. And it happened largely because Chinese smelters have been forced to cut back because they just haven't been able to get sufficient copper concentrate to continue producing at the rate that they were. And so that woke the market up to the fact that, hey, there's actually a supply problem here. Now, when we look at copper stocks in Australia locally, there's not very much to choose from. So it's not a theme that's terribly easy to get exposure to in Australia. There's a couple of copper producers, but they've been disappointing for reasons that could be weather related, reasons could be related to the likelihood for future capital raisings. So generally, outside of our number one copper stock now, which is Sandfire, which is trending quite nicely. The rest is hard to make headway in. West Texas Intermediate crude was up to 81. The International Energy Agency, this will probably surprise a lot of people, and will disappoint a lot of climate activists, but it says demand is likely to keep rising from 2024. They're seeing the possibility that a likely or an expected surplus could end up being a deficit. So, that has certainly lit a fire under the crude oil price. There was a drone attack on a Russian refinery, a significant refinery, which has also contributed to that situation. And also US inventories were down quite sharply as well. Just take a look at one other. This is the copper price while I think of it. So this is copper over the last year, but let's look at that over the last 5 years. So we're starting to get back to levels that that you would expect would be more profitable. But the other aspect to remember that over the last 2 to 3 years, the cost profile has risen significantly for copper producers. Something of the order of 50 to 70% rise in costs. So whilst we're not that far off 5-year highs in copper, that does not translate to a significant profit benefit for the copper producers, because their costs have risen so much. So you could almost look at this the other way and say, well, the price of copper has to go up to incentivize increased exploration and development, because they're just not making as much money out of this copper price as they were 2 to 3 years ago. So there's certainly the dynamics are still very much in play there in the copper market. Turning to other commodities, when we look at lithium, lithium carbonate futures had trended up for a week or 10 days. That looked promising. Prices started to respond to it, and then they got whacked on Thursday night, which is just another reminder that the lithium market is still an immature market. It's still, to a degree, pretty illiquid, and therefore these sudden moves can happen. Now, of course, the big news was PLS conducted or intended conducting an auction. I think it was programmed for tomorrow, but they actually accepted a pre-auction bid, and then effectively said, well, we're not going to do this anymore. So it looks pretty clear that PLS were testing the water to try and get some sort of idea of what the real buying demand is, rather than what might just be a contrived spot price. And the result, I think, was probably reasonable. I think it came in around $1,200 a tonne on an adjusted basis. So that was, compared to where the spot price has been, down around 800, 850. So that was promising in that respect. But it was just another reminder that this market is unpredictable and the spot pricing is unreliable. My overall view is that we're at the bottom, or we're close to it. If we're not at the bottom, we're close to it. But when it'll start to rebound, and the size of that rebound remains a complete unknown. And I think if you burn up any energy trying to figure that out, you're just wasting your time. Just be guided by what the charts are showing you and use good, sensible risk management. It remains an immature, illiquid and manipulated market. So a great deal of care is still required in the lithium sector. And as I said, you can overcome nearly everything with good risk management. You don't have to be a victim subject to whatever the market wants to throw at you. Just exercise good risk management, and it doesn't really matter. Uranium, just a quick one on uranium. I saw prices as low as 85. Now, I don't present uranium price data with any high degree of confidence, because getting reliable data is not the easiest thing to do. There is one source that is saying uranium price into the week at 91. I did see, as I said, a price at 85, but I can't tell you that that was a reliable price source. But the key thing is that uranium was trading at around 106 just a few weeks ago. So there's been a significant fall in pricing in at least some areas of the uranium market, and hence we've had that pullback in the uranium sector. But the long-term outlook still looks very good. So wrapping it all up, it's really important. Successful investors have got a process. They've got a tight process. And members of the Insiders Club and portfolio analysts know that I've got a very tight, repeatable process that I've been using for years and years. And it works. It's a process that's built around clarity of purpose. You've got to be really clear what you're trying to do with this transaction. It's built heavily around risk management, and it's built around patient discipline. And it just beats the pants off any other approach that I know about, except, of course, for plain luck. And if you want to build your future wealth on luck, then good luck with that. It's just not the way to go. Portfolio analyst last week, we looked at the building opportunity in gold stocks in Australia, and also, was the lithium wheel turning? I don't think I need to say much more on that. That's it for this week. There's more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.